Hi everyone. While SCHD investors are celebrating their dividend checks, one simple addition to their portfolio just delivered 50% gains this year, and most dividend investors completely missed it. Gold just hit $4,000 per ounce while SCHD barely moved 3%. Here's what's crazy. The smartest institutional investors aren't choosing between dividend stocks and gold. They're combining both to create what I call bulletproof wealth. And I'm about to show you exactly how they're doing it. The shocking reality dividend investors ignore. Here's the data that blew my mind. Gold delivered 50% returns year to date, while SCHD posted just 3% gains. But here's the thing, this isn't about abandoning SCHD. The institutions buying billions in gold right now aren't selling their dividend stocks. They're doing something smarter that creates protection most retail investors completely miss. Let me show you the numbers. Central banks purchased over 1,000 tons of gold annually for 3 consecutive years. That's $8.3 billion flowing into gold ETFs this year alone. Meanwhile, SCHD keeps paying you that solid 3.8% dividend yield with companies that generate cash regardless of market conditions. Problem number 1. I already own SCHD, why add gold? Here's your comprehensive solution with 3 levels. Beginner approach. Start with just 5% of your portfolio in GLD, that's SPDR gold shares. This gives you inflation protection without abandoning your dividend strategy. Your $100,000 portfolio becomes $95,000 SCHD and $5,000 GLD. Simple, effective, immediate diversification. Intermediate strategy, use a 10% gold allocation with annual rebalancing. When gold outperforms dramatically, like this year's 50% gain, you sell portions to buy more SCHD at better prices. When SCHD outperforms, you add to gold. This forced discipline makes you buy low and sell high automatically. Advanced play. Implement a 15 to 20% allocation using both GLD and physical gold. Add tactical positions during market stress. The institutions holding $101.9 billion in GLD aren't gambling. They're positioning for economic realities that retail investors ignore. Problem number 2, gold doesn't pay dividends. That's a deal breaker. Here are 4 solutions that change this perspective completely. Solution number 1, think of gold as your portfolio insurance, not income generation. SCHD pays you 3.8% annually. Gold protects that income's purchasing power when inflation spikes. Your dividend income means nothing if inflation destroys what it can buy. Solution number 2, use gold's price appreciation to create synthetic income. A 50% gain this year equals 13 years of SCHD dividends in a single year. Sell 3 to 4% of your gold position annually to create dividends, while keeping your principal growing. Solution number 3, combine both for total return focus. SCHD gives you 3.8% yield plus modest price appreciation. Gold gives you 0 yield but massive price gains during uncertainty. Together, they deliver double-digit total returns while protecting downside. Solution number 4, rebalance profits into dividend growth. When gold surges 50% like this year, take profits and buy more SCHD shares. Your dividend income grows faster than waiting for SCHD's 5 to 8% annual dividend increases. Problem number 3, I missed the gold rally, it's too late now. Wrong. Here are 3 reasons and action plans. Why you're not late. Goldman Sachs just raised their forecast to $4,900 per ounce by December 2026. That's another 23% gain from current $4,000 levels. JP Morgan targets $4,000 by mid-2026. The institutional money isn't leaving, it's accelerating. The demand driver. Central banks continue buying 900 tons annually, while annual gold production stays around 3,500 tons. Basic supply-demand math suggests continued appreciation. China added gold for 10 consecutive months. Poland increased holdings by 67 tons this year. These aren't short-term trades. Your entry strategy. Week 1, open GLD position with 3 to 5% of portfolio. Month 1, add another 2 to 3% if gold pulls back 5% or more. Month 3, reach your target allocation of 8 to 12% total. Dollar cost average into your position rather than going all in immediately. This reduces timing risk while ensuring you participate in the structural bull market. The mathematical advantage institutions understand. Here's insider information the financial media doesn't explain clearly. SCHD and gold protect you from completely different financial threats. Let me break down the numbers. SCHD protects through business fundamentals. Companies in SCHD maintained operations and cash flows even when markets dropped 18% in 2022. SCHD fell only 3.2% that year because quality dividend payers keep generating money. Gold protects through monetary debasement. When currencies weaken or inflation accelerates, gold responds immediately through price appreciation. Gold's 50% gain this year happened while the dollar weakened and geopolitical tensions increased. Here's what's crazy about combining them. A $100,000 portfolio allocated 100% to SCHD gives you one protection mechanism. That same portfolio split 85% SCHD and 15% gold gives you dual protection. If dividend stocks struggle but inflation spikes, your gold compensates. If markets crash but inflation stays controlled, SCHD quality companies compensate. Think about this portfolio math. $85,000 in SCHD generating 3.8% yields, $3,230 annually. That's $15,000 in gold gaining 50% this year, produced $7,500. Your total return beats pure SCHD dramatically while reducing risk. The central bank buying explosion creating opportunity. Here's what's happening behind the scenes that creates massive opportunity for individual investors. Central banks accumulated over 1,000 tons annually for 3 straight years, up from just 400 to 500 tons average in the previous decade. This isn't temporary. This is a fundamental shift. China increased gold reserves for 18 consecutive months, adding over 300 tons. Russia added approximately 150 tons annually despite sanctions. India increased reserves by over 200 tons since 2022. Poland made a single 100-ton purchase earlier this year, brings total holdings to over 400 tons. When the world's largest economies aggressively buy gold, individual investors should definitely pay attention. These aren't short-term trades. These are strategic reserve diversifications, creating permanent demand under gold prices. The explosion continues. The National Bank of Poland remains the largest buyer this year with 67 tons. Kazakhstan added 25 tons. Turkey purchased for 26 consecutive months. This institutional support provides a strong floor under prices while creating upside from supply constraints. Your complete wealth building action plan. Here's your specific implementation strategy for maximum results. Step 1. Determine your allocation. Conservative investors, 25 to 30% SCHD plus 8 to 10% gold. Moderate investors, 20 to 25% SCHD plus 5 to 8% gold. Aggressive investors, 15 to 20% SCHD plus 3 to 5% gold. These percentages represent your defensive core. Use the remaining portfolio for growth positions. Step 2. Choose your vehicles. SCHD for dividend exposure at 0.06% expense ratio, GLD for gold exposure at 0.4% expense ratio with $101.9 billion assets. Both offer excellent liquidity for easy trading. Step 3. Implement rebalancing discipline. Rebalance annually or when allocations drift 25% from targets. When gold outperforms dramatically, sell portions to buy SCHD at different valuations. When SCHD outperforms, add to gold positions. This forced discipline makes you buy low automatically. Step 4. Track total portfolio performance. Your goal isn't for every position to outperform every year. The goal is consistent wealth building with downside protection across all economic scenarios. SCHD dividend income pays you while you wait. Gold inflation protection preserves purchasing power. Together they create comprehensive wealth protection. Step 5. Scale strategically. Month 1. Establish initial positions. Month 3. Add during any significant pullbacks. Month 6. Review and adjust allocations. Year 1. Full rebalancing based on performance. The data tells a clear story. Gold delivered 50% gains this year while hitting $4,000 per ounce. SCHD posted 3% but paid consistent dividends. The institutions managing billions aren't choosing one over the other. They're combining both for bulletproof portfolios. Central banks buying 1,000 tons annually creates permanent demand. Goldman Sachs projecting $4,900. Gold suggests another 23% upside. SCHD's 3.8% dividend yield keeps paying regardless of gold's direction. Start building your position now. A 5% gold allocation takes 30 minutes to implement. An 85 by 15 SCHD gold split takes an hour. The mathematical diversification works immediately, creating your financial future while you sleep. The window for entry stays open, but the best opportunities belong to those who act while others hesitate. Smart Money combines dividend income with inflation protection. Now you know exactly how to do the same. This content is educational and not financial advice. Consult qualified advisors before making investment decisions. Past performance doesn't guarantee future results. Please like, share, and subscribe. Here's to your investing success. Profitable investing.